Carvana, the car vending machine with great marketing but a much less effective business model, had a terrible, and I mean terrible 2022. But in 2023, at least for a brief few months, it seemed as though Carvana may have been reining themselves in. In Q1 of this year, Carvana beat revenue expectations. They narrowed losses, improved their margins, though they are still losing a whopping $4,000 for every single car that they sell, and their stock is up quite a bit from their December 2022 lows. For the last few months, it seemed as though there has been at least a slight possibility that Carvana could escape potential bankruptcy proceedings. But as of last week, it is officially confirmed that Carvana is still a long ways from being out of the woods completely, at least whenever it comes to a bankruptcy. And truthfully, things don't look very good. You see, Carvana was a company that exploded during the pandemic, and during 2021, when the car market went absolutely nuts, Carvana experienced their first profitable quarter ever. But profitability was short-lived, because in 2022, when car prices began to fall, Carvana really struggled. Not to mention Carvana's very poor reputation when it comes to their customers, titling issues, and selling the occasional stolen or salvage title car. No big deal, right? Carvana's issues go well beyond falling car prices, but by the time the general public began to take notice of all of the company's problems, car prices were falling, the car market was crashing, and as a result, Carvana's issues are almost always solely blamed on the car market as a whole and factors outside of Carvana's control, rather than Carvana's poor and shady business decisions, which are things that I've covered in a number of different videos. This all came to a head in December when it was announced that Carvana's debtors had reached a debt deal, essentially saying that if Carvana ends up filing for bankruptcy, these debtors need to work together in order to come to a conclusion and a resolution that will benefit everyone. This type of debt deal is put into place whenever a bankruptcy is most likely going to be on the horizon. At the very least, it is a large possibility, and it's designed to essentially prevent debtors from running each other over in order to get the best deal as possible. This was the first time that we really heard about Carvana talking about bankruptcy, and it was the first time that we had confirmation that bankruptcy discussions are absolutely being had behind closed doors. But that debt deal was set to only last for 3 months, and because it was signed back in December, it most likely ended at some point in March. Now, truthfully, it's hard to tell whether or not that debt deal did in fact expire, because whenever you look online to figure out what ended up happening with that, there isn't anything that's reported in the news. It also wasn't mentioned in the Q1 earnings release. But I believe that it is safe to assume that the debt deal probably did expire, because had it been extended, I would assume that it would have been reported on, given the fact that Carvana is a publicly traded company. Then back in March of this year, Carvana announced a restructuring plan for their debt. A restructuring plan for debt is something that is very common in the world of business, and basically it means that debt gets moved around so that either the company doesn't owe as much debt or they have a longer period of time to pay it off. This can be done in a number of different forms. For example, a debt for equity trade, where basically a company will trade off their debt in exchange for equity in the company. This type of arrangement can be attractive to a creditor if they feel as though that company is going to have a higher worth in the future. But if the creditor feels as though this company doesn't have a bright future, then they of course wouldn't want to do this deal, because that equity in the company wouldn't be worth as much in the future than it would be in present day, and they're better off holding on to the debt instead. This isn't what Carvana was proposing, but it is an example of how restructuring can work. You can also do a debt or a bond swap. This is where companies will sell or even trade bonds in exchange for lowering their debt or extending their debt payment terms. For example, a company may trade a bond that's due this year for one that's going to be due later on down the road. This is, of course, a really oversimplified explanation, but it's really all you need to know for the context of Carvana. And this type of debt swap is similar to what Carvana was looking to do. In March, it was announced that Carvana would offer their debtors up to $1 billion in unsecured bonds at a discount price in an effort to extend repayment deadlines on their current debt or exchange debt that is due soon for other debt that is due later on. Did I mention that Carvana has over $8.3 billion worth of debt? $5.7 billion is unsecured debt. And traditionally, whenever we look at debt, an unsecured form of debt is much more risky than secured debt because there's no collateral associated with unsecured. So the vast majority of Carvana's debt is in fact unsecured, which is not a good thing. So this debt deal was essentially designed for Carvana to tell their debtors, hey, we'll let you buy this debt investment at a discount if you let us pay off this other debt for a longer period of time. And the reason why Carvana would want to do this is because Carvana has over $234 million in debt payment that is due this fall, which you can see here in this graph provided by Bloomberg. A smaller amount is due in September and October, but a massive amount is due in November. So the clock is literally ticking for Carvana. By making this debt deal, it would be a great move for Carvana, and an essential one, because not only would it mean that they're offloading some of their debt, but it would also mean that they have an extension on paying the debt that they already owe, which is due very, very soon. But last week, the final nail was hammered into the coffin whenever it comes to getting this debt deal worked out, because it was not accepted by debtors as creditors refused to exchange their notes. This leaves Carvana with limited avenues as their cash flow is still extremely tight. The car market is still going down, and the due date for their debt is very literally coming closer and closer by the day. This is not only a major blow for Carvana and another sign that bankruptcy may be inevitable for the company, but it's also a strong sign that debtors and creditors aren't as interested in investing in the car market as they once were. For example, back in 2021. Car-related debt was viewed as a great investment in 2021. In fact, the car market outperformed almost every other investment vehicle that year, and as a result, debt investors got into the action of buying billions of dollars worth of auto-related debt. But that has come to an end. With bank failures, car prices tanking, and borrowers are beginning to default, debt associated with the car market is becoming a much more risky investment, and as a result, creditors simply don't want to touch it. This is not only true with Carvana, but it's also true with large dealership groups and banks. And while this is a different debt than what we're talking about with Carvana, all of these are signs that the car market is cooling down, it's becoming a much more risky business, and creditors, banks, and debtors are getting much more conservative with how they spend their money. And so while the creditors' refusal to work out an agreement with Carvana is absolutely a reflection of both Carvana and the future of the company, it's also a reflection of the car market as a whole and our overall economic situation. This isn't good news for Carvana, and it seems as though we may be able to get a lot of insight on the future of Carvana, as well as whether or not this company will need to file for bankruptcy closer to the fall whenever this debt is actually due. And I believe that by the end of this year, we should really have some strong clarity on where this company is heading long term. But like always, you guys, I hope that you enjoyed this video. If you have any questions, comments, if you have anything to add, I would love to hear it, so make sure to leave a comment down below. And while you guys are at it, make sure to hit the like button, hit that subscribe button, and hit the notification bell, and I will see you guys in the next video.